Good afternoon, everyone. Welcome to the FX Hour for Shadow Trader. I am Blake Young, taking you through the next hour as we discuss all things Forex. Specifically today, we're going to be looking at price patterns as we've had some interesting support and resistance levels setting up and some opportunities that I think will provide for significant moves where we've had a lot of consolidation in the markets and a lot of decreased volatility. Specifically in the Forex market, but in many of the markets, we will look at some opportunities here in the very short term. So before we get started, just a reminder, you can follow us at MyTrade. Go to MyTrade, search for Shadow Trader or Shadow Trader FX Trader. You can follow us there along with the other Shadow Trader traders out there, and you'll get our daily commentary, newsletter, updates, calendars, etc., as well as what we're looking at in the charts and what we're setting up on the trade alerts on there, as well as getting the newsletter. Remember, this is here every week, and this is recorded and will be posted to the shadowtrader.net website under archives under FX Hour. Let me switch this to a tighter image of the charts so we can get into that. And let's just make sure we have the right chart going here. Right size chart, better said. There we go. And about now you should be able to see the S&P chart that we're looking at. Now this is something we did the fibs before, and we're looking at this long-term trend, and I was watching from the low to the high initially, and then we saw it stall out and come back, and we've seen it come back and test the 50, but you can see that these areas are still holding up as support and resistance. Long-term support and resistance bouncing off of the 38% level here, and then testing the 50, but now testing the 38% as resistance. So I'm looking at this, and my anticipation is that really we're going to be trading in this range. We're going to be trading between 1900 and we'll call it 1902 and 1950, likely throughout the rest of the month. We'll trade back and forth. We may try and attempt a breakout, but my anticipation based on lighter volumes that we normally see towards the end of August and into early September, and with the fact that we still have fear, but we're obviously not selling off really dramatically, that the S&P is probably going to trade in this range. It's going to widen out a little bit, just a little bit over the next few weeks, and maybe even have a slightly bullish bias, but I anticipate that we trade sideways through there in the time frame that we were looking at between now and the end of August, early September. Now, if the markets are staying flat like that, the question is where we're going to find the opportunity. Where is money moving to? And as we look at gold, gold has traded up to the same resistance. We keep talking about the same support and resistance levels through here, and we've stalled, and this is a price pattern. We have a top side and a bottom side on this. This would be obviously a rectangle or a channel, and we're going to duplicate that. We'll drag it up here, and you'll note that that also matches up to some previous resistance areas. So if we do clear this again, I would expect that gold is going to probably rally up to 1342, and that's not a big move. We can probably do that in 1 or 2 days. But I am leaning slightly bullish and really looking at this next move, one more duplicate of this channel and one more duplicate of that price pattern, and probably coming up to test right around here where we offset. And as you know, many times when I look at support or resistance, if we have a bullish candle and a bearish candle of equal or greater size, I'm willing to cut off the engulfed or overlapping part to see where that is. And so I'd be targeting closer to 1373, and I do think we probably will see a little bit of move up on gold. And so, like I said, right now, likely see a little bit of move up on gold. But one of the things I would note, and this ties a little bit to what Steve Miller is probably saying, Dow, is that when we see gold and we see the dollar, and overall, and I'm not talking about just 1 or 2 days, but I'm talking about these trends that we've seen in July and August. When we see July and August where gold is rallying and the dollar is rallying and the S&P is not moving up, and then we look at and say, well, what has the overall dominant trend have been of bonds? And that has been overall up in August, September as well. When we see that, or July, August, September, when we see equity trading flat, but we see gold rising, the dollar rising, and bond rising, this is fear play. This is different than what we see normally. And so when we see gold and the dollar and bonds go up, people are looking for somewhere safe. And as we're looking at this, looking for a safe move, that is what is getting me convinced that we will probably see a push higher and still see a push higher in gold, but a push higher over the next couple of weeks in the S&P. but will probably fail at 1950, 1957 towards the early end of August, early September. I've zoomed out so you can see the end of August, early September. Call it 1957 tying to some of these previous resistance and support, and I think we will probably cross through that, but let's call it 1957 by August 28th, August 29th, where we put in a top, and then we have a lower high and lower low, and then we probably see it drop down and probably come down to test 1880. And it wouldn't surprise me to see a bigger drop, a more sizable drop, back down to some deeper support levels, and even our fib fan lines in this 1880, 1884, where we have previous resistance and that trend line. So sometime the first or second week of September, I would anticipate we hit those levels. And so falling back to the 1880 by first, second week of September, again, it is a drop. I'll give you that. Is that significant of a drop? Is that scary? If you're buying up at 1985, that might be scary. If you're buying even at 1950, 1957, when we rally up there and you see it drop and you're talking about a 3 to 4% move, that might be scary if you happen to buy at the tops. But 3 or 4% move in a long-term position, a big bullish move overall, I anticipate the equities will stabilize. And part of the reason why we'll stabilize is because the U.S. is still being seen as a safe haven. I went through and looked at all the bond issues of, well, most of them, not all of them, of the developed countries. And Germany is one of the lowest. Its yields, not their what their banks are offering, but their current yields are about 1.1%. Ours, even with the fall that we've seen in the 10-year Treasury and testing these lows, we're still at 2.4. And so seeing that move and seeing that we're sliding down, but Germany is still way lower, I think that we're seeing that there's failure and there's weakness in the global markets and failure and weakness in the euro. And the ZEW came out this morning, and that's true too. Germany, yep, Germany is about 1.1% in their bond yields. And I can't remember what the Swiss was. I think they're like 1.5 or 2. So they're not a lot. They're still lower than what we are. And so, yeah, and what we have is we have all these things going together, and this is a situation where Angela Merkel and Mario Draghi have talked a lot about the idea of being accommodative and how that we're trying to stimulate the economy and help the European economy. And yet, we haven't seen a lot of action. And we see Russia is still not. When they said last weekend, they said, hey, we're backing away. And the market said, hooray! And they said, we have 45,000 troops on that border. Ooh. And we see the move go back and forth. We see that we're not really seeing a lot of confidence. And as we're looking at that, we can see also in the charts that confidence is not there. We're not creating a bounce in the euro. The demand for the euro is not very high. Now add to that, if you would be buying into the euro US dollar, if you had been buying this when we were creating this double top or when we broke through price pattern wise through this low, the move that we've seen in this time frame, we've seen price drop 2.5% in a matter of about 3 months. So 2.5% down in 3 months. So if you were just buying straight out euros, I'm not even talking about with leverage. I'm not talking about the spot market. I'm not talking about the futures market. I'm saying if you would have bought euros flat out, zero leverage, you would have lost 2.5%. So when we're talking about banks just moving money over to the euro, if they move money to the euro and put it in German banks, they're getting a 1% on a German bond over a year, and they're losing 2.5% over the last 3 months. That is a problem. That is a net loss situation that no one's, big banks and those that are moving money around in significant quantities are not going to be happy with. So that's a problem. That's some weighing down on the market. Now we have created this new pattern, and I'll do the yen next, and then we'll do the pound. We'll go through a bunch of these here. But as you can see, we did create a double top, and this double top right through here had a range of about, I'm not going to get laser point accurate on it, but it had a range of about 235 pips. Well, if it broke out 235 pips, we would see it drop down and find support right here, which it did. And then we stalled 1 day, 2 days, and then broke lower. And that's also, by the way, where we exited our euro US dollar short position that we were trading before. And now we drifted lower. Now we created this lovely little support area that it's trying to trade back and forth across and trying to decide which way it wants to go. We have lower highs. We have these equal lows. This is a wedge. So we have a bearish wedge on this situation. And if it breaks out through this bearish wedge, the base of the wedge is approximately 306 pips. So we broke out, came back in, broke out, came back in. So now we are breaking out again today. And we're poised to close below this level again today. So 306 pips is going to take us down to 130.60. 130.60 is actually going to push us through the target that I was watching, which was the annual low here. And that takes us back further And I'll just show you 130.60. If I can get it to line up. Right here. We had some support and resistance back and forth. A lot of consolidation around that key point. But we have to go all the way back to 2012 to be able to see it. Yeah, so what I'm doing, just so you can see that, anytime I'm using the trend line drawing tool, it tells me, let me draw it a little lower, it tells me the number of days, which is calendar days, the number of bars, which is total candles, the percentage move, the pip move, which is 0.0473, would be 473 pips, 0.9, and then the angle of my line. Up here at the top, it also tells the same thing. So looking at all that move, this is poised to go lower, and it looks like it should have very little problem hitting the annual low, but possibly going all the way down to 130.60, pushing through that annual low. Remember, where we have that reversal right here, where bearish candle, bullish candle, offset it, overlapping portion, I'm initially watching for this 130.168. But the 130.60 area is the next target. So let's do the yen, and then we'll hit the pound. We're going to hit all the majors here early on, and you'll notice we're going right into the price patterns, and we'll hit lots of currency pairs today because I think there's opportunity. So what do we have? Support levels here. We have resistance levels here. Now this is a weird looking descending triangle-ish kind of pattern. Now the descending triangle or a descending triangle pattern that we're looking at here is not normal to have it descending at a support level in between. Generally, it's nice when it's in an uptrend. So as we're looking at this, this is a little bit tougher to reach, and this is some of the struggles that we might have with this. This has gone sideways, but it's gone sideways down in a long-term uptrend. And so this is a rough pattern to read. It's difficult to read, and this can break up as well as it can break down, as we've seen in the past, because it's not a traditional descending triangle. Descending triangles should generally happen at support. Rising or ascending triangles should be at resistance, and these are opposites. So these are almost pennants. As you look at these, they're almost a pennant type formation. And so if we can break out of this, the base either direction, I'd be willing to look at this for a breakout of approximately 399 pips. We'll call it 400 pips. Now we've tested this here, 400 pips. If we break through the high, if we see ultra confidence, US dollar going higher, 400 pips would take us up to 106.64 roughly, if it does it over the next couple of days. And we'd be looking at 400 pips pushing us all the way through the highs and coming up to 106.64 right here, right in that range up to the top. Now that target, that potential target, is a long-term upswing. But if fear kicks in, if we do see the sell-off, remember that historically speaking, a higher fear, more uncertainty, more problems, more struggles that we're dealing with in the markets, then that usually causes short covering. And if we're looking for short covering, we're looking for bearishness. That bearishness or short covering in equities, or better, excuse me, that bearishness in equities oftentimes creates higher volatility and short covering of the yen, which would drive this lower. Hang on just one second. Hey everybody, sit tight with me for just a second. So if that happens, if we look at this, then I'm looking at the 400 pips to the downside. The yen would actually get stronger. And it's not necessarily this is the pair that I look at, but if we break through that support level, I'd be looking for 400 pips down this area, which means that we're dropping down all the way back down here into the 97 area on a price pattern alone. Let's do the pound. Here's the pound. Now the pound has been interesting because it was so strong. It had gained so much strength. It had a strong bullish pattern. It went through here, and then it changed. It shifted gears. And as we watched it shift gears, trying to be able to attack, and we talked about the channels before, trying to be able to attack those channels and what we're looking at there, this is the pattern that we would have looked at. We would have seen it have a rising pattern, and that is a channel. And so if we look at this initially, I'd look at this as a bullish channel and a bullish channel is a bearish trade. So a bullish channel, if it breaks through the channel, we expect it to duplicate and run down to that next level. Now that would still give us room to move. We've already broken through it. It still gives us room to move, and I'd be looking for this support area. That support area is also going to match to some of this previous support and resistance areas through here. So previous support and resistance areas through here, that's the area that I'd be watching, and we're kind of shifting. Yes, we had some rallies today on a gap up, cleared out some seller shorts there, and then pushed back to this level. This is a bullish pattern. But if we continue the bearish pattern, because the bearish pattern hasn't broken through its resistance level yet, then I'm looking for a buy opportunity either right through here at 167, or a potential buy as a bounce down here at 165.96. And we are watching this. This does have an overextension. This is a pair that is definitely overextended to the downside. We've created another bullish cluster. If we want to talk about that bullish cluster confirmation would be a close above this candle, which is about 168.51 from an indicator point of view. But if we don't get that rally, if we don't get that push higher, then I'm looking for a bullish buy without confirmation down at a previous support. Let's look at the Aussie US dollar. And looking at the Aussie US dollar, what do we have? We had a bullish trend through here. Price traded flat through here. We traded sideways through there. We broke out, came back in, broke out, came back in, and this is a failure. Now let me use this one to springboard into the idea and the discussion points of looking for reward risk ratios. When we're looking at price patterns and reward risk ratios, one of the things that I like to do is if I can measure out the distance between a support and resistance and a reward risk ratio and say, okay, what is this? And it's not going to show me the number here, so let's try it this way. In this situation, I've got 204 pips. So if I know I've got 204 pips, rather than waiting for a close outside of that range, a true breakout, I can look for this to give me a 20 pip or 10% of the expected range or 10% of the expected price pattern as a breakout. And as if I'm looking for 10% of the expected move or the breakout in this situation, then what I'm looking for is I'm looking at that as being a 20 pip breakout and looking for the remainder of the 200 pip move, which is 180 pips. What happens there? That gives me an opportunity to look at 180 pip risk or potential gain with 20 pip stop and a 20 pip breakout, which gives me a 9-to-2 reward risk ratio. If I'm looking at 9-to-2 reward risk ratios and I'm setting up for that opportunity, then the 9-to-2 reward risk ratio will give me opportunities that I only have to be right 2 out of every 9 times. And you can do the math if you want, but that's what it is. So if I look at a 9-to-2 reward risk ratio, I only have to be right 2 out of 11 times. Actually, what I'm doing, let me repeat that, Money Miser. When I have a breakout of 10%, let me draw it, because I have it built right into my fibs. As you can see here. Oh, I can show you how to build it out. How about that? So if I'm looking at this, and I was looking at this to break through the downside, I can measure the fib fan or fib extension, and what I'm going to do is I'm going to edit the properties on this. And so what I look for is I look for it to break out 0.1. I'm looking as a stop loss, a negative 0.1, so that's going to be my stop loss. I'm going to change this one to blue, because that's going to be my entry. And then I'm going to look at the green as my target. Of 100%. And so what that gives me is this. If I break out, I'm giving up 10% on the breakout, and I'm putting my 10% back into the price action. Do you see that? So 10% breakout, 10% on the price action. That leaves me with 10 to 100, which is the 90%, and 10 to 0 to negative 10, 20%. That's why I have a 9-to-2 reward risk ratio on that. And that 9-to-2, again, I only have to be right 2 out of every 11 times to break even. Anything above that is actually winning. So as we're looking at this, one of the things I usually do is I usually leave in the 50% level, because if it comes to the 50% of the price pattern, I'm going to move my stop to break even or within, actually in profitability. So it usually looks like this. And you can still use the Fibonacci's, the 61% levels. If you like what I just did there, you can just save it as your default. And then then you have, every time you draw a price pattern, you have this little magic tool that'll tell you where to get in and what the price action is. So now as it's approaching these lows and it's coming down here, you can see it's stalling out. But if the Australian dollar does break through support, either it closes below 92.20 or it breaks through 92 even. If it breaks through 92 even, I can take a short. I'll take a short with a target back down to 90.15, and my stop loss would be at 92.41. Now request for the dollar Swiss, we'll go to that one next. Then we'll go back to the New Zealand dollar as our follow-up. So the New Zealand, the dollar Swiss, you can see we've been watching this. It created a double bottom way back here, confirmed the double bottom, broke out, came back, would have stopped us out, broke out again, and hit the target. So if we would have used our Fibonacci extension like so, let's see how this would have played out. Okay, if we'd have taken entry, this would have been an entry. We would have taken a bullish entry on the dollar Swiss. It pulled back and hit our stop. On the same candle, it also got us into the trade again. So we would have been back in the trade at 89.39. So we have one loser. This one rallies up, pulls back, rallies up, but it hits the 50%, which means we move our stop to break even or better. And this would have been a zero or a neutral trade. So we have one loser, 1-0. We pull back inside that range. We break out again. That would have triggered the trade. We come back. We have a stop. That's a loss. We break out. We're in the trade again. Come through the 50%. We move it to break even. And now we hit our target. So we have two losers, 1-0, one winner. Are we making money on that strategy or not? If I have a 9-to-2 reward risk ratio, let's put numbers behind it. We're talking at about a move from 89.39 up to 91.09. That is 180 pips. So if we're looking at 180 pip move, how much did we lose each time? When we lost from 89.40 down to 89.02. You want to get specific, 89.39 to 89.01. So we'd be losing 38 pips twice, which means we lost $76, but we would have profited 180 on the next move. No commissions in the Forex market. Isn't that fun, Money Miser? No commissions in the Forex spot market unless you're doing the micros. And so there's the setup, there's the opportunity, there's the breakout, there's the target. Bingo. We only have to be right 2 out of 11 times. This has been right once out of every 3 times, with one being we're ignoring the zero trade. Now that we've hit this target, is there another price pattern? I think there is another emerging price pattern in the dollar Swiss. Still looks like it's trying to be bullish. It's still up at these resistance areas, but if you look at this from the idea that we have all this consolidation through here and these lows back through here, this to me looks like we're trying to form a new bullish channel. If it's going to fail here at the resistance, I would anticipate it does pull back to this channel support. And if it finds support there, then that's where I'd be looking for another bullish trade. Or if it broke through, then I could treat it as a price pattern again. Fall back, bounce off support, rally, break through that high. We'd be looking for the next move. If it breaks through the channel high, that channel is about approximately 155 pips. All right. That's the dollar Swiss. Like I said, overall bullish. I wouldn't be surprised to see a pullback and a bounce and a target, but we already hit the recent target. That was our goal. That was what we expected, and it did it. And that's what we talked about in the previous weeks. Let's go to the New Zealand US dollar. And then we've got 3 more dollar crosses, and then we'll get into the other cross pairs. Now this one's a little bit interesting because we're pulling back to horizontal support area right through here. And we've tested that support. Trying to capture the top on this, I would probably be willing to have a couple of failed trades and confirmations at a tighter resistance area because these ones offset each other, these ones offset each other, but then it confirms this is support and resistance over here. So now we got this sideways channel going on the New Zealand US dollar. And if that's the pattern, the distance we're talking about is from 87.14 down to 84.20. So roughly 300 pips. That means if it breaks out to the downside, as it's approaching down to this level, then we'd expect it to move that far. Again, let's use our Fibonacci extension to measure that price pattern. It doesn't matter where we anchored, it's simply just looking for that price pattern to break out. And so either we get a close below this 84.14 or we cross the 83.75 area to get us into that trade short with the target down to 81.11. Price pattern breakout. Stop loss right back inside that range. If it fails and reverses, it needs to come back in that area. I would be cautious even with this really low volatile time, even when the candles, our average candles here recently have been 58, 42, 62 pips. The distance between our support and resistance here, or excuse me, our entry and our stop is 84.41 to 83.81. So we've got 60 pips there. So I'd just be a little cautious with the fact that one candle can cover that range. Generally, tighter ranges, we say, oh, we're okay, but that's fairly tight on this, even with that big 300 pip move. I'd just be a little bit aware of that. Now, we've seen DBA, Deutsche Bank's Agricultural Fund, continuing to drift lower. That certainly is going to add some weight to, or tether the New Zealand down, and that could be one that could keep the New Zealand US dollar from rallying when we have agriculture prices continuing to struggle and sell off. Let me bring down that volume a little bit. Seems a little hot there. All right, long term, just for fun, we're going to be doing fib fans next week. But long term, I just want you to note the DBA is right at the 61%. New Zealand US dollar in its big rally that we had off of the low, not to the highest point, but to the strongest point, we're right at the 50%. If we go up higher and go to the highest point, you can see we're still away from the 61%. But if we use that 61%, that's about the breakout area that we were looking for anyway. We've done the pound, euro, pound, New Zealand, Aussie, US dollar, Swiss. Let's do the US dollar, Canadian dollar. And the US dollar, Canadian dollar has been rallying again. We know that with oil prices sliding down, it's not too much of a surprise to see the US dollar winning against the Canadian dollar. But we're right at this resistance, and it's getting fairly choppy again. I might call this a cup and handle. Whether I call it a cup and handle or not, it doesn't really matter. What I'm looking for is this idea that we have this little support and resistance area here and this big scooping area here. Generally, I prefer to see cup and handles at the top of resistance or an inverted cup and handle at the bottom of support. But we're seeing this little pattern here. That pattern still holds true. What do we expect? Let's duplicate it. If it breaks through the highs, then theoretically we come back to test and even break this high. That wasn't very accurate. Should have been exactly right there. There we go. So that would be an expected move, but we also have a short-term channel on this as we're watching this, where the trend and the pattern is overextended to the top side. We've now gone through it sideways, so I would probably even say this short-term move is a funny-looking bull flag, called a bull flag in a stiff wind, because we've had consolidation after we hit resistance, 1, 2, 3, 4, and today would be 5. So 5 days of consolidation. Generally, we look at that as a minimum, if you read Pring, minimum of what we'd expect for this to be a bull flag. So we have that 5 days of consolidation. It's gone straight sideways, but it's still 5 days of consolidation. This move from 107.26 up to 109.76 is about 250 pips. So even off the shorter term target, we expect 250 pips. We might let this come through the highs by 25 pips. If it's going to run that distance, then it's likely to finish out the entire distance. Let's duplicate this one. Let's use our extension. And that puts us right there. All right, let me just read through some of the chats. Actually, we did the dollar yen, dollar Swiss, dollar CAD. We've done all the majors against the US dollar. Let me just read through the chats really quickly. So Money Miser, do you know that you can do diagonal fibs for channels? Watch this. Channel. Low. Let's go all the way to that high. Right click on it, edit properties, and then just change them. We can add curves. So we'll add a 100. We'll add a 0.618. 0.382. Ta-da! There you go. Fib channels. And it held pretty well through there, didn't it? See all those resistance and support and resistance and support and resistance, support, resistance, support, resistance, etc. Back and forth. Sure, it's the same. Just save it. Save it as your default. All right. So Fiber is looking for the SPX to pull back even more aggressively and looking all the way back into the 1600s. You know, that move, here's the thing. This is what I would say. If you look at earnings, we've had more positive earnings and more positive revenue adjustments in the last couple of years, in last year, than we have on average over the last 5 years. So our earnings are outperforming. But we've also have about 65% of all the companies that we've talked about have given bearish guidance or less bullish guidance. And so as we're looking at this, we seem to have a lot of earnings that would support the equity market staying high. Like I said, the pound and the dollar and bonds have all gone up together, and that is usually an indication that we're in for a correction. The correction, even if we saw a 10% correction, we're only looking at coming back into the 1760 area, 1770 area. We'd have a 20% correction, and you're looking at the up here my percent change. If we're looking at a 20% correction, we're looking at possibly falling back to that 1580, 1600. But that's a 20% correction in the move, and I don't know if I see it in the charts right now. Partly because not because we don't have the capacity to sell off that hard, but because the world is using the U.S. as a safe harbor, and that's why I'm a little bit cautious with that idea of pushing it that far. So I'm looking at 1880, and like I said, my target, let's call it September 8th. Is that oddly specific enough? So we drift up and test the highs maybe by 826, 827, but then we fall back by September 8th to test that low. So read the Euro ETF, the FXE, is that the one you're referring to? Is this the one you're referring to? Because if this is the one you're referring to, it tracks the Euro US dollar almost perfectly. The only difference, the reason why it gaps and has all the gaps around the chart, is because it is only traded on the U.S. equity market. So as we look at this, when we look at these moves and this sideways action, you see we have a 99.08% correlation. That's just because it gaps every day, because it only trades U.S. equities, while the Euro US dollar trades 24 hours a day from Sunday till Friday. But you can see 99% correlation, even on the corrections of the futures and the rollovers and the way they change on the monthlies and quarterlies. You can see even that only drops down to 97% correlation. I'm going to call it almost perfectly correlated. What do I say to LE? Well, let's look. Because we saw the agricultural prices earlier, just a general DBA. I think we talked about this last week, right? That when we saw wheat and rice putting in a base after testing annual lows or multiple year lows, live cattle started selling off when the other one was rallying. So what happened? Today, price pattern wise, what is that? I don't know what it is. It's a dromedary camel as far as I'm concerned. It's a Loch Ness monster. We have a couple of humps right through there. It's not a traditional pattern. I would say it's a widening pattern. A widening pattern oftentimes leads to higher volatility and trend change. And so when we have this widening pattern, the megaphone type pattern, we're breaking through support today on cattle. And so if we're looking at this, we know that demand for oil has dropped. We might be just seeing global demand in general across the board, everywhere we look. Global demand of consumption is down. And whether that's the case or simply that we have more cattle, I have no idea. All I know is that we have this situation where from a price pattern perspective, regardless of what supply and demand is, we are deeming this to be too expensive. And so we have just broken through key support and we're closing through key support right here. So that close for the support. Because it's a widening pattern, the first target I would start with is this base, and this base is about 5%. The second target would be the larger component, which is about 12%. So 5% would take cattle futures down to previous resistance somewhere in that range. 12% would take us even lower, and we're looking at, off my chart, somewhere in this range. Let's use our fib extension to measure that second one out. There's a breakout. Oh, so I measured that wrong. So there's the target, about 136 on the downside. And I'd look for that 50% mark on the first one to not only give me an area that I might take profits at, but also to see if it can break through and tighten stops. Let's get rid of this correlation. So cattle falling down, look at something like corn. And even though we're trying to put in a base, you can see we put in a new low shadow today. Look at wheat. And again, this is the 2-year chart that we're looking at. So we were at 2-year lows. We've rallied, but as you can see, wheat selling off. We're just seeing agriculture prices not doing well. We haven't turned the corner on agriculture prices. And until we do turn the corner on agriculture prices, I would expect this to break through the support, and that means DBA possibly back down to 2409. From a price pattern, you have this letter H. We have a funny looking bear flag, and that bear flag would give us that same expected move. Let's go off the high to the low, and if we call that a bear flag and we already broke out, that gives us target down to 24. If you're looking at just this move, this little double bottom that's going to be possibly failure as a double bottom, that puts us down to 2520. But that 2520, 2470, and even down to 2409 is really the price targets I would be lining up. Let's go back and look at gold. We'll hit gold, copper, silver. Remember, fibs are just percentages, Money Miser. That's all it is. So whatever range you talk about, if you want the same pattern, the same range, then it's simply a percentage of the move. So starting with gold again, we talked about the fact that we're right at resistance. It's played sideways so many times that I like the channel that it's trading in here, and if it breaks through that, then I'd expect it to test the highs. If we look at a little bit longer time frame, off of those lows, we'll turn those red. I said let's turn that red. There we go. So if that's our lows, let's look at our long-term highs. Now, if we go off the 2 years, it looks very different than what we look at on just the 1 year. So if we went off the 2 years, we'd have something like this that's already ended that trend, so that's not important to me. It's done. It's over. We're out of there. So really the only one that I'd be looking at is the change of the pattern, the change of the trend that we can identify through here. And if I anchor and cut through those, cut through all those up and down, like I said, because they offset each other, and through this one, you can see I can hit multiple points. 1, 2, 3, 4, 5, 6. So as we're looking at that, let's edit that one. Let's change it to red, make it a wider. This gives us a super pattern. Okay, off the super pattern, big move. If we see the breakout, let's talk about what gold could really do if we saw a significant breakout. I'm still bullish. I'm back to bullish, I guess, not still, because I wasn't bullish before. I've been bearish for a long time, but I'm now looking at this. If I'm gonna guess a short-term move, I'm guessing bullish. From the long-term move, if it can break through the highs, then that's going to give us a potential move on a price pattern of a super triangle that could take us all the way up. There's a 50% taking us back to these highs, and the 100% theoretically takes us back to 1537. Zoom out on this, and you can see that 1537. There really isn't much there. There's a little support test there. There's not a lot of reason to think that it wouldn't go higher than that. If we're looking at the downside, if you draw just a little bit to the right, then it should give us a right side only extension. Now, if it does break through the downside, that puts us all the way back down to 1,063 on gold. When's the last time we were on 1,063 or at that level? Haven't been. 50%'s been there. Let's go back even further. $10. Looks like we have to go back to 2009. So 2009 in the run-up, that's where we saw that. Crude light. Now, crude light I've been bearish on, and we're still bearish on it, and we keep consolidating right in these support areas. So this is a great example, again, of both price patterns, channels, and the things we've talked about before, that I've got two different price patterns in two different channels, one bearish, one bullish, and they've intersected right here at the bottom, and we've stopped. We haven't bounced, we haven't broken. We just keep testing it. What does that tell us? When we test right there almost perfectly, where both support and resistance meet, we bounce up, and we keep coming back to retest. We've retested the breakout 3 different times. Tells me that with this area, when it is broken, or if it's broken, not only would I expect it to move this channel width, and this channel goes from 103 down to 98, let's call it $5, or back down to this area, which is about $6.50, $6.75. Just to retest that support. Now, we could break through here, bounce up, retest this as resistance, and we might take some time to do it. But even on this move right through here, I would still call this a bear flag or a channel. Either one you want to do. Beauty's in the eye of the beholder here. And we have this high to this low. And if this is a bear flag, we certainly have consolidation for 1, 2, 3, 4, 5, 6, 7 days. And so if it breaks through the downside, that bear flag would move this distance and that distance is going to take us at and through this downside, if that's the one we have. But because this offset each other, I'm willing to cut those off, as we said before. Let's cut that off, activate drawing, cut it off to right there, then duplicate, and there you go, magically right at that next level. So if we putter around and go sideways a couple more days and then break out, I wouldn't be surprised to see it retest here, and that's my target, 92.34. If this holds up, I don't think I can trust or count on a breakout unless we clear this top resistance line. So until we break through 100 again, I'm not going to believe that it is going to be bullish until we clear 100. But if we break through 97, close through 96, 70-ish, then I would be looking for a move back down to 92. And the fact is, we've really focused on a lot of the supply side situation we've got going on with oil. We have a lot of supply. Even in spite of the fact that we have all the conflict with Russia, we have a lot of supply going on right now. And that supply and that idea that we have excess supply, the U.S. is producing more than it has in a long time, and Libya has been producing more, and even though Russia has had its problems, we have a lot of supply. And so that's why oil prices have come down. We've come off of the 108 all the way down to the 97. And now if we break down, we'll drop down to 90, 92. And so just off the highs, if we do hit 92, we're talking about a 15% correction. That's a significant correction. That also takes us right down to where? To the annual lows. And that's why I'm looking at that 92. Silver's going to look, let me get that pull up. Silver's going to look a little bit more dead, in my opinion, than gold. We had all this consolidation and price pattern back through here. We've rallied up. We're starting to fall back down. It's not as active, even though recently it looks like a lot like gold in this move, but previously it wasn't trading flat. It's been selling off. When gold was trading flat, silver was selling off. In addition to that, if I'm looking at this as a potential bull flag pattern, the rule that I like to follow and is kind of accepted is that if a flag pulls back and closes inside its 50%, it's no longer a flag. If the flag portion is a greater pullback than 50% of the flag pull, don't count it for a flag anymore. Now, if it holds up at this support area, the 61% is really trying to hold. If gold is going to rally, like we commented, I'd just be looking for a swing high. That means I'm going to be looking back up to 21.49 if it can hold at support and give us a solid bounce. This fits better, in my view, lining up to that 38% level so well and finding support so well at 61%. This would fit the Fibonacci technique that we've talked about in the past, where I like to look for it to close in between 38 and 61, and then if it breaks either side, I target the 0 or the 100 respectively, and I place a stop at the 50%, and that's what's worked historically really quite well on silver or on fib retracements. And I think we did that 3 weeks ago, 4 weeks ago. Let's hit copper bonds because these all tie together. So copper, what do I use copper for? And I know I get some disagreement on this, and that's all right. You don't have to agree with me. I just I have the microphone, so you can disagree all you want. No, you don't have to agree with me, but I believe that copper is the leading indicator for overall sentiment on the market. On true growth, this is my growth indicator. But if we have lower highs and lower lows, we've just broken through that support area. Some of the support areas that I would have been watching, we broke through the support area through there. I look at this and say we have bearishness. If we throw in a Fibonacci retracement on that as well, from the low close to the high closes, you can see we're testing the 50%. But this is starting to look fairly bearish to me. This looks like we have some downward mobility. And so if I'm looking at that as being potentially a bearish move, and we're breaking through, especially if we break through the 50%, our next major support area is all the way down here at $3.11. We might find support at a little bit higher level, depending on how fast it falls. Because it'd have to fall pretty fast within the next day or two for me to trust the trend lines or the horizontal support. But if we're watching this, I would look for this to drift lower like it has already. It's broken through there. Let's duplicate it. And watch it now drift in this lower channel. Let's see if we can find support at 305. Now, if you're a futures trader, 305 from 315 is a very nice move in copper. And as we're watching for that move, that still tells me overall growth is slowing, and that would also be an indication that I'd expect copper to sell off. One of the comments is, as far as when we're looking at all of these markets, when we're looking at the correlations, and we're looking at the moves up and down. Leopold, that'd be really interesting. I'd like to look at it. Just zip it over to my email, fxtrader@shadowtrader.net. What are the dynamics about going together for the bonds, dollar, and the S&P that lead to correction? Generally speaking, if we see gold and the bonds and the dollar going up, let's break it up into pieces. If equities are not rising, but bonds are rising, well, bonds are a safe harbor play. When we're looking at buying into bonds, we say, hey, the U.S. government will probably stay solvent, theoretically, and therefore bonds should be, out of the goodwill and the good faith of the U.S. government as well as the U.S. taxpayer, the U.S. bonds should be stable and strong. And so the idea is that we run to the bonds. If equities are not going up and bonds are, that's a safety play. But if the dollar is getting stronger as well, that is also a safety play because it means we're going into cash. If there's more demand for the dollar, that is either because we have significant deflation or disinflation, or we're seeing people run into cash. Gold has historically been a safety play against inflation, but also at times of uncertainty. And so when those three major instruments are going up together, we see the diversification of risk avoidance. And when we've seen that happen historically, if it lasts for any amount of time, historically speaking, we have seen the prices in equities pull back. I'm just reading here, sorry. And Fiber's talking about some slopes and other things. I think it's a great idea. I look for those repeats, so if everybody sees that. Averages since 1928, 62.05 weeks average down, 63 weeks averaging an incline, 47%. Average decline, 27%. Average cycle below the 55-week moving average is 108 weeks. So are we through the 55-week moving average? Is that what you're telling me? Just for fun. I know we're doing price patterns, but hey, Inf information is information. The question is whether it's good information and can give us opportunity. Well, if we look at this, you can see we've crossed through that 55-week a number of times. So if our average is 108 weeks, then theoretically we'd have a lot more time below that moving average before we'd see that meet the average. And we've had a lot of pushes through there that weren't as significant of a sell-off. So it's something to watch. Let's get some... Oh, wait, I just had some others here. Hang on. Hit the bonds again. Now I find this interesting. We have the bonds. Here's the 30-year bond. Boy, we only have 7 minutes. 30-year bond. We've broken through resistance. We pulled back, broke through again, and now we're pulling back again. If I were looking at this as a price pattern, you can see we ran past the 50% on this most recent move. So theoretically, we'd move into our move our stop to break even if we were trading bonds. But we still have an uptrend going on. And that uptrend is still potentially in play. As we're watching, this is what is intriguing to me. Is again, I said this earlier, right at the beginning, that German bonds are about 1.1% yield, and U.S. Treasuries are in 2 to 2.5 to 3% yield, depending on which time frame you're looking at. As bond prices are falling down, you can see right through here, we would be looking for, expecting to see yields go up. And a lot depends on how the demand is hit, and we can look at the ZN. This is the 10-year. You see it's rolling down not as aggressively. It's also created these higher lows and broken through those highs recently. But as we're watching for this to pull back, it's interesting to me that that pullback in that resistance area right through here, we've broken through that resistance at the same time the 10-year Treasury has hit its multiple year lows. We crossed through those multiple year lows, and right now we're testing today the break through the previous support area that we had prior. Now the consolidation we had up here that's going to match to the support resistance on the other chart still has some room to move. We can still come up to 2.46% or 24.6 on the 10-year Treasury. And that's going to match this support area right here at 125.18. If it bounces off 125.18, we see a rally, there's going to be higher demand for bonds. And again, that's that safety play. And yields are going to drop. We have not, mortgage numbers have not shown that yields are at 2-year lows. We're not seeing more refinancing. We're not seeing more buying based on what we're seeing in mortgages and home purchases. We're not seeing the same numbers that would justify it. We're not seeing 2-year highs while we're hitting 2-year lows in interest rates. So that's a little side note as well. Just reading through again. We hit crude light. On it saying watch Mankind. Yeah, Mankind just got pummeled. All right, I got to get down to the more recent stuff. Well, and PBAC, I know this is one the area that you and I have talked about. That if you pull the U.S. Geological Survey, even though we don't use copper throughout the entire house for plumbing, it's still used for line sets. It's still used for, you know, for multiple things in the home still. We have copper in from the street, copper inside, copper in the line sets, copper in all the electrical. So even though plumbing may be dropped down, according to the U.S. Geological Survey, copper still is the highest single use is homes. The second, though, is becoming cars because of all the hybrids. Hybrids and electric. Just reading through. We've done all the major pairs. We'll start looking at some crosses here. We only have about 4 minutes to go. Do I see a correlation between the drop in open interest and the drop in price of copper? That's part of it, Leopold. I think as well, it's just simply global demand. All global demand is dropping. We saw. Did you see industrials? XLI and industrial sector is the second worst performing, right behind utilities, is the second worst performing sector. And so over the last 3 months. And so looking for that bearishness, looking for the sell-off in that is not only the open interest is dropping, we see that, but you can see we can have open interest drops and see these drop down, and we see it spike up, and then it turns a corner, open interest drops, and then, but even as open interest spikes, prices can drop. See that? And if we went back historically, there are times that open interest is dropping and prices are rallying. So open interest, remember that can be just open contracts, whether bullish or bearish. and open interest on the futures, people can be selling the futures open contracts as well. You can't have a seller without a buyer. You can't have a buyer without a seller. So that is part of it, but I think it's overall just lower demand. Here's the Mexican peso for you. Silver, as we said, is drifting a little bit lower, and we expect some weakness in that. If we expect weakness, I'd expect the dollar Mexican peso to bounce off of previous support and resistance. This is not the prettiest pattern, but I would still look at this and call it a funny looking W. The big W, according to Mad World. Kind of creating a consolidation, then broke out, and if I cut off that portion right there through there, this pattern right through here gives us a target of 2,522. On the breakout, 2,522 would take us right into this area. We cleared that and retraced, so there's that engulfing pattern again, and that's exactly where 2,522 sits. So we overshot it and came back right down to that level, and we were holding at that pattern. There's so many chats. Just reading. All right, let's do soybean. Like we did with corn, wheat, they're all at 2-year lows, if not further. 3-year lows for soybean. Agriculture prices are just getting hammered. So why I would also say if we're agricultural is struggling, and I know this is the FX hour, but I'm just going to throw this out there because it's something that I was thinking about a lot this week. Things like Deere, we have data from both the European Central Government as well as the U.S. government talking about loans, and the loans are showing that there's not as many loans going on. Mortgage loans, business loans, they're just not there. We're seeing less and less people borrow, even though interest rates are at historic lows. You're not going to buy a $300,000 combine if agriculture prices are in the toilet. If you see corn, soybean, wheat, cattle all hitting lows, and we see that they're not borrowing money, why would we expect to see Deere outperform on its earnings? Just a thought. And they might. Maybe they'll surprise us, but the fact is people don't spend money if they're not borrowing money on these $300,000 units. I have family members that are large farmers, and they have the ginormous Deere tractors and everything else to go with it. And so if agriculture prices are 2 and 3 and 5-year lows, and we're not seeing an increased demand, and we're not seeing lending going up, then what does that tell us? I would expect this to drop. And so going back to soybean again, clearing those annual lows, we've got this very aggressive downward trending resistance. If this is a pattern, which it's a stretch to call it a pattern, if this is a pattern through here, a consolidation and breakout, then 50% target's 33, 100% target's 31, 32, and we have still some downside potential. Yes, this candle is putting in a shadow, but overall we're still in a bearish trend. We are over time, believe it or not. Has a lot to cover. Yeah, and Dow, reversion of the mean, you know my view on that. Reversion of the mean does not mean reversion to the mean. Sometimes the mean comes to price. It's not necessarily reversion. So if we took a regression channel and said, here's the price action that we saw through here, at the time, if you saw this breakout through resistance and said, oh, it's going to revert to the mean, at the time your mean is down at 38.20. Did it really revert to the mean when it came over here 6 months later, or is it that the mean changed? Because if we look at the mean changed and we came up to it. The average price came to it, not the other way around. So I'm always cautious about mean reversion games because the market can stay, as the saying goes, the market can stay irrational longer than you can stay solvent. And so, and also, when are you going to start your mean reversion? When are you going to begin to say, this is the time frame I'm willing to look at? Because if I go off the year, the mean is 38. If I go off of the price action here, we're above the mean. If I just go off that drop, we're above the mean right now. So just be cautious with mean reversion, because you have to define what you're going to call the time frame, one, and two, price oftentimes continues in the direction it's moving, and the mean comes to the price. So, all right. Thanks for being here, everybody. Yeah, and the mean changes with time, exactly. Thanks for being here. We'll get this posted and recorded. It's recorded. We'll get it posted to the website. I appreciate everybody taking the time to be here with us today. If you have questions, you can email us to fxtrader@shattertrader.net. We covered a lot, covered all of the majors, and we covered all the major equities and commodities as well, or indexes and commodities. And so hopefully you like that. Next week we'll be covering fib fans and some discussion points there. I'll be broadcasting from Dallas, so hopefully we'll be able to get all the technology to work there as well. So thanks for being here, and we'll talk again next week, same time, same place.